So if I first kick off, obviously, on telecommunications sector, the two that I think have potential negative share price reaction. First one is NextDC. We do have a hold recommendation on this stock. We think that it'll hit its guidance, the upper end of its guidance for FY19, and the consensus for FY20 is fine. So not worried about numbers. However, what we are worried about is the rate of sales that they contract. So just a reminder, to fill the facilities that they're in the process of building, they need to sell at around 25 megawatts per annum. We think they're going to sell at closer to 15 this year and probably a similar number going forward, but some of the more bullish analysts out there expect them to sell at a very rapid rate. So really important in this result is the rate of sales that they contract, or the megawatts contracted. If that's not quite a high number, we think that will come back. We're also conscious of the debt position on NextDC. If you look, it's around 6 times, which is relatively high, so we think there is a risk of a capital raising. Second stock just to touch on is Superloop. Clearly, we already know the FY19 and FY20 EBITDA numbers, so no negative surprises there. In fact, that's quite a good number in terms of 100% underlying growth. However, what we don't know is the balance sheet, and I'm just a little bit concerned about the debt position heading into that result. If the company is able to pull off a transaction, which has clearly been on the cards for some time, we think they can bring some cash into the business and lower that debt position, but just highlighting that it's probably around 5 times net debt to EBITDA, so a little bit of risk there around the balance sheet heading into that result. On the positive side, Telstra and Over the Wire. So Telstra, we think it's the trough. Clearly not a lot of growth coming here, but we do think there's 3 key factors that are of interest that should re-rate this. Number one is the competitive environment. Fixed and mobile prices are actually both trending higher, so the cycle has turned. Number 2 is the cost out program, the simplification and cost savings. And number 3, probably most significantly, is this InfraCo business, which optically they're splitting out. We will know the whole financial kit and caboodle, and I think that comfortably adds around $1 to the valuation. So as people get comfort with that, we think you'll see a valuation re-rate as the infrastructure business is worth more than the more retail sort of transactional business. And then Over the Wire, this is one where we're forecasting about 18% growth this year and slightly less next year on an organic basis. I think it's a high quality result. There's just been a bit of nervousness, including from us heading into this result, as to what the outlook looks like. Whether they're growing at 10 or 15% organically or even 20 next year, I don't know, but all of those numbers are really good numbers. And I think that given expectations, and the share price have both pared back quite a long way in the last few months, I think there's a buying opportunity in this stock. I think it's comfortably worth $4 per share based on FY20 without any growth whatsoever, and it's pretty much trading at that level now. I do think you'll see them grow the business organically, and I do think that you'll also see them do some M&A in the next 12 months. So happy to do that. So they're the kind of key 4 ideas. Just the cycle, I've been through this a number of times, but I do think we're at the bottom. I do think 70% of the way through the NBN equals the competitive landscape is getting better. Things are changing, prices are going up in mobile and fixed, and 5G obviously resets the competitive landscape. So that's the overall arching themes for the sector.